Hi, this is Indranil and you are watching Business Bites in our channel The Spotlight, India's first online business news channel. In today's Business Bites, first news we have JSW Paint to acquire AkzoNobel India, the maker of Dulux Paints parent AkzoNobel N.V.'s 75% stake at 9,000 crore. Second news we have, Titan is set to acquire Gulf jewelry retailer Damas International's 72% stake at 2,500 crore. Third news we have, Leela Hotels launched their IPO to raise 2,500 crore at a price band of 413 to 435 per share with a lot size of 34 shares. Fourth news we have, Tata Motors EV business to achieve profitability while Starbucks India's losses surged by 65% in financial year 2025. And fifth news we have, direct-to-consumer health supplement products are getting positive traction with VC funding when safety concerns are equally rising. In first news, JSW Paint to acquire AkzoNobel India, the maker of Dulux Paints parent AkzoNobel N.V.'s 74.76% stake at 9,000 crore at a valuation of 12,000 to 12,200 crore. After announcing its decision to review business operations in the Indian subcontinent in October last year, Akzo India in February agreed to sell their powder coating business, which is the unit's most profitable stream that contributes close to 12 to 14% of sales to its Dutch parent AkzoNobel N.V., as there is an intense competition in the Indian paints industry and the resultant margin squeeze has also led to valuation getting impacted for this deal. Akzo, the company, has about 7% market share in India and is one of the most profitable in the segment, with an annual production capacity of 250 million liters, and they are focused on high-end decorative paints with its Dulux brand. And the company had experienced low single-digit growth in value in the December quarter, while profit has down by 5% as the automotive and vehicle refinishing segment faced challenges, and that had given a negative impact on their overall performance. The JSW promoter, led by Group Chairman Sajan Jindal, is planning to put 3,000 crore as equity for the buyout, while another 3,000 crore is being financed through banks, while the plan is to keep privately owned JSW Paint and Akzo India as two separate businesses and not initiate a reverse merger between the two. JSW turned profitable at an operation level for the first time in financial year 2024 with an operating margin of 3%, and this acquisition will help JSW Paints towards 10,000 crore revenue, positioning it for a public offering in the foreseeable future. Decorative paints comprises 75% of the total demand in India, which is led by repainting and new construction, where JSW will gain the intellectual property rights for decorative paints, while it will pay a royalty for industrial segment products to Akzo India's parent. The financial year 2025 was one of the worst years for India's paint industry in nearly 3 decades, with business contracting when it came amid increased competition with the entry of the Aditya Birla Group's Birla Opus in February last year, while at an industry level the demand fell by 4 to 5% in financial year 2025. In second news, Titan is set to acquire Gulf jewelry retailer Damas International 72% stake at 2,500 crore. Titan Company is in advanced talk to pick up a 72% stake in Damas International, which is one of the most prominent Gulf jewelry retailer, for an estimated 2,500 crore, for which the Tata Group company has commenced due diligence, when the remaining 28% will continue to be held by Manai Corporation, which owns Damas International. Titan has initiated auditing the books of Damas International, and they also started working on how the company will be restructured, and also the stores may have the name Damas by Titan. Damas International was acquired in April 2012 by a consortium led by Qatar-based Manai Corporation and subsequently became its wholly owned subsidiary, which is a well-known jewelry retailer in the Gulf Cooperation Council region with a network of 251 stores where they offers an attractive combination of Damas in-house collections of jewelry along with a wide range of international brands. On the other side, apart from jewelry, the $6.7 billion Titan has a diverse portfolio spanning wearables, fragrances, fashion accessories, and Indian apparel. Titan's jewelry brands include its flagship brand Tanishq along with Zoya, CaratLane, and Mia by Tanishq. Tanishq has a significant presence in the Gulf too, with 13 stores out of which 10 in the UAE, 2 in Qatar and 1 in Oman, and in December 2024, it opened a flagship boutique in Dubai Gold Souk, while Tanishq international footprint including Singapore now stands at 23 stores with 21 Tanishq outlets and 2 of Mia by Tanishq, when Titan's jewelry division posted total income of 46,571 crore in financial year 2025 with a growth of 21%. In 2024, the Gulf Cooperation Council jewelry market was valued at $14.1 billion and is projected to cross $24 billion by 2033 at a CAGR of 5.7%. And this expected growth will be fueled by factors like increasing financial wealth and a strong cultural association with gold, where the UAE is a key player in this market as their gold jewelry demand ranked 5th in the world. In third news, Leela Hotels launched their IPO to raise 2,500 crore at a price band of 413 to 435 per share with lot size of 34 shares. Sklos Bangalore Private Limited, the company which owns and operates luxury hotels and resorts under the Leela brand, plans to raise 2,500 crore through an issue of fresh shares to repay debt and 1,000 crore through an offer for sale, and after the initial public offering, the promoter group stake will fall to 75.9% from 100%. The Leela founded in 1986 by late Captain C.P. Krishnan Nair, when the company had 13 operational hotels with 3,553 rooms as of March 2025, where out of these 13 properties, 5 are owned and 8 are managed through franchise agreements with third-party hotel owners, while they are having 5 hotels in the pipeline, and by 2028, the company plans to launch 7 new hotels with addition of 678 keys. The company operates in a highly competitive sector and has lower revenue per available room compared with larger peer including Indian Hotels Company, EIH and Ventive Hospitality at the consolidated level, when their share of revenue from room income increased to 52% in financial year 2025 from 48% in financial year 2023, while that of food and beverages reduced to 37% from 38% during that period. The company posted their operating revenue as 1,300.6 crore in financial year 25, which was 860.1 crore in financial year 23, while their revenue per available room increased to 10,696 from 7,828. The operating EBITDA margin was also improved to 49.8% from 46.9% during the period, when the company reported net profit of 47.7 crore in financial year 25 as against net loss of 61.7 crore in financial year 23, and the IPO will be closed on 28th of May. In fourth news, Tata Motors EV business to achieve profitability while Starbucks India's losses surged by 65% in financial year 2025. Tata Motors electric vehicle business posted a positive operating EBITDA margin for the last financial year, and that made them among a handful of EV makers globally to achieve this, when this improved performance was supported by increased localization, aggressive cost cutting and productivity linked incentive benefits, and this was even as Tata Motors EV declined market share with rising competition from companies like MG Motor and Mahindra & Mahindra. Tata Motors EV currently have 6 models which include Tiago and Nexon, when the revenue from the EV business dropped to 8,187 crore in financial year 25 from 9,285 crore in financial year 24, Not only so, their retail market share fell to 55.4% from 73.1% during the period. But the EV market leader Tata Motors still managed their EBITDA margin rising by 8.3 percentage point to 1.2% from a negative of 7.1%. On the other side, Tata Consumer Products' own Starbucks reported a 5% growth in sales to 1,277 crore, while their losses widened by 65% to 135.7 crore for its operations in India in financial year 25. In India, the US headquartered coffee brand Starbucks operates through an equal joint venture with Tata Consumer Products under Tata Starbucks. A year ago, the company reported a loss of 82 crore with sales of 1,218 crore, and during the year 58 new Starbucks stores opened, which is fewer than last year's 95 new stores. The company expanded into 90 new cities, which also included Tier 2 cities. And with that, in total, the Tata Starbucks is now having 479 stores across 80 cities in India when they committed to increasing their store base in India to 1,000 outlets by financial year 2028. And in fifth news, direct-to-consumer health supplement products are getting positive traction with VC funding when safety concerns are equally rising. A decade ago, India's health supplements mostly meant vitamin C, iron and B12 tablets purchased at pharmacies after consulting a doctor when the supplements wave in India surged by increased health awareness after COVID-19 pandemic and powered by social media influencer marketing, which was eventually became a preferred business model for startups with a rush of venture capital showing their interest in this segment. The supplement products are being sold directly to consumers on e-commerce websites as well as quick commerce apps. In this fast-growing segment within the health sector, when most of the items are sold over the counter with no prescription, no pharmacist, and often no clarity on whether they actually work or not. India's nutritional supplement industry was at $47.92 billion in 2024, which is projected to expand to $68.43 billion by 2030 at a compound annual growth rate of 8.1%. And this growth story has attracted both founders and venture capitalists. When after seeing good acceptance from the audience and more usage of digital platforms, e-commerce and quick commerce to buy such products, brands started experimenting with their offerings. And with this trend, some health professionals are beginning to worry that the focus is shifting from effectiveness to aesthetics. As the wellness sector is booming in India, which is why a lot of companies are getting a lot of VC funding, and the founders are using a lot of that funding to basically not to work so much on the formulation but more on the marketability of a product. However, the marketing-first approach leads to many consumers buying the products without understanding them, and sometimes overusing them, which is creating a reason to worry. As most supplement products in India fall under the purview of the Food Safety and Standard Authority of India and not the drug regulator. That means weaker scrutiny and lighter penalties despite brands making bold claims like improves liver health or reverse aging. With the rising trends of these kinds of false commitments, an interministerial committee headed by former Health Secretary Apurva Chandra recommended that any supplement claiming to treat or mitigate a disease should be classified as a drug, and that would bring such products under the Central Drug Standard Control Organization and subject them to stricter regulation. So these were the top 5 business newses from Business Bytes in our channel The Spotlight, India's first online business news channel. I would like to request you to please subscribe this channel so that you can have all the updates from our end. Thank you very much for watching Business Bytes and signing it off.